Certain assets have historically shown themselves robust during the market turbulence and economic downturns, supporting wealth and providing stability when the majority of investments fail. In the midst of the upheaval, investors can find chances and safeguard their portfolios by identifying these hidden treasures. These 7 assets, which include strategic cash reserves, precious metals like gold, and specific energy plays, provide as safe havens for investors during market downturns, allowing them to weather the storm and set themselves up for future gains. Here is a short introduction to 7 secret assets that survive market crisis. Number 6. Collectibles and luxury assets. Fine art, vintage automobiles, luxury timepieces, rare wines, diamonds, antiques, and expensive handbags are examples of collectibles and luxury assets that provide a special kind of wealth preservation that is mainly unrelated to conventional financial markets. Rareness, craftsmanship, cultural relevance, and collector appeal are the factors that give these material goods their worth. And these factors can hold steady even in times of economic recession. In order to maintain value, expert verification is necessary due to the risks posed by counterfeiting and provenance difficulties. Despite these difficulties, well-chosen collectibles can be a long-term wealth store and a hedge against currency and inflation concerns, especially for investors who respect their aesthetic and cultural significance. Number 5. Foreign currencies. During times of crisis, diversifying into stable foreign currencies is a calculated strategy to shield wealth from inflation, depreciation of the home currency, and geopolitical threats. When native fiat currencies decline, holding foreign money can act as a safe haven and lessen exposure to the hazards connected with a country's political or economic unrest. However, geopolitical events, interest rate fluctuations, and worldwide developments can all have a substantial impact on foreign exchange markets, leading to abrupt changes in currency values and considerable volatility. Access to effective currency exchange mechanisms and knowledge of macroeconomic patterns and timing are necessary for managing currency exposure. Investors must be ready for possible losses from exchange rate swings, but they frequently employ foreign currencies as part of a larger hedging plan to maintain liquidity and purchasing power during uncertain times. Number 4. Cryptocurrencies, Bitcoin and others. A contemporary, decentralized substitute for conventional fiat money and banking institutions. Cryptocurrencies led by Bitcoin are appealing in times of capital controls, hyperinflation, and financial system collapses. Bitcoin is known as digital gold because of its limited number of 21 million coins, which simulates the scarcity of gold and positions it as a possible inflation hedge. Rapid transactions and access are made possible by its digital, borderless nature, even in the event that traditional banking infrastructure is damaged. Notwithstanding these benefits, cryptocurrencies are extremely erratic and vulnerable to speculative bubbles, hacker threats, and regulatory ambiguity. With innovations like tokenized precious metals, which combine blockchain technology with traditional commodities and institutional interest, the crypto sector has grown considerably. Although cryptocurrencies can help with liquidity and diversity during emergencies, their risk profile is higher than that of conventional safe havens. Therefore, they should only make up a tiny, carefully managed part of a crisis portfolio. Investors have to balance the risk of large losses and regulatory crackdowns with the potential for disproportionate rewards. Number 3. Cash reserves. A key component of crisis readiness is keeping cash on hand, which offers instant liquidity to pay for pressing costs, prevent forced asset sales at low prices, and take advantage of buying opportunities during down markets. The most liquid asset is cash, which can be stored in a variety of ways to improve accessibility and security, such as digital wallets, bank deposits, and actual currency. Cash, on the other hand, is a non-appreciating asset that gradually loses purchasing power as a result of inflation, particularly during protracted crises characterized by extreme inflation or currency devaluation. Investors frequently balance cash holdings with other assets that are resistant to inflation in order to lessen this. Cash's function as a liquid buffer is essential for survival and operational flexibility during systemic shocks, banking disruptions, and market crashes, despite its lack of growth. It gives investors financial flexibility and psychological stability, allowing them to deal with unpredictability without resorting to distressed sales. Number 2, defensive stocks and sectors. Because their goods and services are necessary, regardless of the overall state of the economy, defensive stock, mainly in consumer staples, healthcare, utilities, and pharmaceuticals, are renowned for their ability to withstand economic downturns. Even during recessions, people continue to purchase food, medicine, electricity, and healthcare services, which helps businesses in these industries maintain steady cash flows and revenues. These companies frequently distribute dividends on a regular basis, generating income to offset portfolio losses during the downturns in the overall market. Defensive equities are a mainstay for risk-averse investors looking to preserve capital, because they often show reduced volatility and outperform cyclical sectors during crises. Additionally, these industries frequently recover more quickly after a crisis, providing growth potential in addition to downside protection. In times of market volatility, adding defensive equities to a diversified portfolio helps lower overall risk and even returns. Number 1, real assets and businesses. Farmland and real estate are examples of real assets that offer income streams and actual physical value that often outlast economic upheavals. Because it produces food, a necessary good whose demand stays the same or even rises during downturns, farmland is particularly valued in crisis situations. A hedge against inflation and currency devaluation, real estate can produce rental income that is frequently tied to inflation and usually increases in value over time. Another layer of financial security is added by owning successful companies with consistent cash flow, as these ventures are more resilient to market downturns than speculative investments and offer expansion prospects once markets rebound. Real assets are essential parts of a crisis-resilient portfolio because of their practical utility and minimal connection with financial markets. Additionally, as real assets keep their inherent value and usefulness beyond paper financial instruments, physical ownership offers psychological stability by assisting investors in preserving their wealth and ability to function during systemic shocks. You may create a more robust portfolio that weathers market downturns by comprehending and implementing these 7 hidden assets into your investment strategy. To secure your financial future and navigate uncertainty, keep in mind that planning and diversity are essential. Keep yourself educated, maintain your self-assurance, and use these resources as a buffer during difficult times. If you liked our video, please hit the button and subscribe to our YouTube channel.